Welcome to the Deep Dive. Today we're plunging into, well, a really fascinating corner of the European fintech landscape, Poland. Specifically, we're unpacking the story of IFirma SA, that's IFI.WAR, on the Warsaw Stock Exchange.
Right.
Imagine this, a company not just surviving, but actually thriving in a pretty specialized niche. And it's perfectly positioned for this massive government-mandated regulatory shift that's coming.
Huge, yeah.
But at the same time, they're squaring off against this, formidable, really well-capitalized competitor. It's quite the tightrope walk they're navigating.
It really is.
So our mission for this deep dive is to extract the most important insights. We're looking at an in-depth investment analysis report, company disclosures, industry insights, basically trying to help you understand iFirma's unique hybrid business model, the intense competitive landscape they're in, and I guess the strategic choices that are going to define their future.
And what's truly insightful about iFirma, I think, isn't just that they blend, old school trust, especially crucial in accounting with new age tech. It's their very deliberate strategy. They leverage the inherent human element in complex financial services.
Ah, okay. So not just pure automation.
Exactly. While lots of fintechs chase pure automation, iFirma's Biuro Rachunko model we'll get into that strategically builds these human-powered switching costs. That makes their core offering incredibly resilient. In a way, a purely digital competitor might really struggle to replicate.
That makes sense.
We've synthesized a lot of complex financial and market info here, aiming to deliver, clear, actionable knowledge for you.
That's powerful framing. So let's start by grounding ourselves. What does iFirma actually do, and how did they get here? Because they have a pretty long history, right?
They do, yeah. It traces back to 1997, actually. Initially, they were operating under a different name, Power Media SA. It wasn't until 2017 that they did this significant rebranding to iFirma SA, and that move really solidified their focus on their core digital platform, ifirma.pl.
And they've been on the Warsaw Stock Exchange for a while.
Since 2008. So, yeah, long track record. And their entire operation, as we'll see, is just laser-focused exclusively on the Polish market.
Okay. And the core business is?
It's providing comprehensive internet-based accounting and business management services. They mainly cater to Poland's huge network of sole proprietors. They call them JDG locally. Stands for Jednoosobowa Działalność Gospodarcza.
Right, the sole traders.
Exactly. And also small and medium-sized enterprises, SMEs, and increasingly the booming e-commerce sector. That's a big one now.
And you said they're really focused on that platform, ifirma.pl.
Oh, absolutely. Preliminary results for 2024, for instance, show a staggering 97% of their total revenue coming directly from these ifirma.pl services. It signals a near-total pivot, really, to their digital accounting offerings.
Wow, 97%. That's serious concentration. But when we talk about internet-based accounting, it sounds maybe a bit generic. Is it just software, or is there more to it? How do they structure these services to, get and keep customers?
Yeah, that's a great question because it's far more nuanced than just selling software. If we connect this to the bigger picture, iFirma's business model is meticulously designed. It's got this tiered approach that doesn't just maximize customer value, but critically builds incredibly high switching costs.
The stickiness factor again.
Precisely. Promoting that long-term stickiness, this is where their hybrid model really shines. It lets them appeal to a pretty broad spectrum of small businesses while holding onto their most valuable clients really tightly.
Okay, so break down these tiers for us. What's the top?
Right. At the top tier, their premium offering is called Biuro Rachunko. Literally translates to accounting office. And this isn't just a software subscription. It's a comprehensive full-service solution. Clients who go for this tier get assigned a dedicated human accountant.
A real person.
A real person. This professional manages pretty much everything. All the bookkeeping, complex tax calculations, PIT, CIT, VAT.
PIT is personal income tax. CIT is corporate.
That's right. And VAT, value-added tax. They also handle Social Security filings, that's ZUS in Poland, and importantly, they even communicate directly with the Polish tax authorities on the client's behalf. They act as a trusted intermediary.
Okay, so it's almost like having your own outsourced accounting department, but delivered digitally. That sounds incredibly valuable, especially for a small business owner trying to deal with Poland's, notoriously complex tax system.
It is incredibly valuable.
But wait, doesn't staffing those human accountants inherently limit how much they can scale? I mean, compared to just pure software solutions, how do they plan to scale that high-touch model across potentially millions of businesses?
You've hit on a really critical point there, and from my firm's perspective, this segment is a goldmine precisely because of that human element. You're right, it's less scalable on a per-unit basis than pure SaaS, but it generates highly predictable recurring revenue. Why? Because it's a non-discretionary service. Businesses have to comply with tax regulations, and trust me, Poland's are not simple.
Definitely not.
This fosters really deep client relationships, and critically, it creates those exceptionally high switching costs we talked about. Think about it.
Yeah.
If you're relying on a dedicated person who understands your specific business, your documents, your tax history, maybe even holds power of attorney, moving isn't just migrating data.
No, it's breaking up with your accountant.
Exactly. It's severing a trusted relationship, rebuilding that trust somewhere else, navigating the admin hassle of transferring power of attorney. That combination, indispensability, and deep integration makes Bureau Trinkoe their core value proposition, and arguably their strongest competitive moat against purely digital players. They might not scale it to every single business, but the ones they have, they'll keep a very firm grip on.
That makes a lot of sense. So given that high value and stickiness, how do they actually price this premium accounting office service?
It's structured to reflect that value, naturally. Pricing is tiered. It starts at a pretty competitive 149 PLN per month, that's Polish zloty, for a sole proprietor who uses a simplified lump sum tax basis. That's common for smaller businesses, freelancers.
Okay.
But for more complex entities like limited liability companies, Spółka ZO.O in Polish, which have much more extensive reporting needs, the monthly fee can go up to 650 PLN. So it scales with the complexity and the volume of the client's business. They capture value proportionate to the service they deliver.
Right. Okay, that covers the premium full-service tier. What about businesses that maybe want something more hands-on or just a purely digital self-service approach? Maybe they're more tech-savvy or price-sensitive.
Yeah, they cater to them too. For those clients, IFirma offers Księgowość internetowa. That translates to self-service internet accounting.
Okay, the SaaS model.
Exactly. This is their pure software as a service, or SaaS, solution. It empowers users to manage their accounting independently through the ifirma.pl platform. They leverage the software's features to handle their own books. It's designed as that more scalable, lower-cost alternative.
Yeah.
Appeals to entrepreneurs who are, like you said, more price-sensitive or just prefer to handle things themselves. Maybe they have simpler operations.
Got it. And then I noticed something else. Program Due Factor, an invoicing program. Is that just a basic tool, or is there something, clever going on there strategically?
Oh, you're spot on to ask about that. This program due factor is actually crucial. It functions as an exceptionally powerful freemium customer acquisition tool.
Freemium. Okay. How does that work?
Users can issue up to 3 invoices per month completely free.
Ah,
It's a brilliant way to get new businesses onto their platform with zero initial financial commitment. They get to experience the user interface, the basic functionality. Then, for higher volumes, or for more advanced features like integrating with popular e-commerce platforms, users can easily upgrade to paid tiers, things like Factura Plus or the e-commerce module.
so this is a pharma.
It creates this really clear, low-friction upsell path, brings in a wide base of potential users who can eventually be converted to their more comprehensive, higher-value accounting services. It's a very smart funnel strategy feeding their core business.
That makes a lot of sense. A low-friction way in, hoping to capture them for the bigger services later. Now, what about those smaller legacy bits you mentioned? IT recruitment, software development. Do they still matter at all?
Yeah, IFirma does still retain some of those smaller legacy operations. IT recruitment and software development, they're not central to the strategy. Definitely not. But interestingly, an analyst report did note a surprising 12% year-over-year revenue improvement in this segment in Q1 2025.
No.
Yeah, it's a small kind of curious detail. I mean, their overall impact on total revenue is negligible. We're talking less than 3% of the top line, truly.
Right.
But that little improvement, maybe it hints at broader trends in Poland's tech talent market, or perhaps a slight re-emphasis on these complementary services for diversification. For now, though, it's firmly a sideline. The core focus is absolutely ifirma.pl and accounting services.
Okay. So taking all that into account, the tiers, the focus, the legacy stuff, what does this mean for the company's long-term health, its sustainability? It sounds like they've built a very sticky model.
It's exceptionally sticky, yeah. The business's sustainability is just deeply rooted in the non-discretionary nature of Polish tax and accounting compliance. Businesses simply have to do this, regardless of economic cycles. And
Sure.
as we noted, Polish regulations are, well, complex.
Understatement.
Right. This creates permanent, resilient demand for IFirma services. Now, on scalability, the SaaS and freemium parts are highly scalable. They can onboard loads of new customers with minimal extra costs.
The accounting office part.
That accounting office segment, as you rightly pointed out, is less inherently scalable because it needs human accountants. But that human element is precisely what creates those incredibly high switching costs. Remember, it's not just data migration.
Right, it's the relationship, the power of attorney.
Exactly. Severing a trusted relationship, finding a new advisor, dealing with the admin, that's a formidable barrier to leaving.
And I noticed a point about their adaptive approach with e-commerce integrations.
Mm-hmm.
That seems like a really smart move, given how online retail is just exploding everywhere, especially in Europe.
It definitely is. Very strategic. They've
Oh.
built integrations with major e-commerce platforms that are popular in Poland,
Yeah.
like Allegro, which is an absolute giant in Poland and Central Europe,
Right, yeah.
and also global platforms like WooCommerce and Shopper. This move directly targets a significant and rapidly growing part of the Polish economy, online merchants. They often have very specific accounting needs, right? Multiple transactions, different payment gateways, intricate tax calculations.
Like sense.
By integrating, iFirma positions itself perfectly to capture this segment. They offer a streamlined solution that directly solves a major pain point for these businesses.
You've painted a really clear picture of how they deliver value. But who are they for, exactly? How has iFirma refined its strategy over time to hit that specific customer segment, especially with that 2017 rebranding you mentioned?
That's a great question, and it really speaks to their consistent vision. That 2017 rebranding wasn't just a name change. It was a very sharp strategic pivot, focusing almost exclusively on their fintech and accounting services.
Right.
But what's truly remarkable, I think, is how stable the leadership team has been through all this. President Wojciech Narciski, he's been guiding this vision since the company's founding back in 1997.
Wow, that's longevity.
And his vice president, Aniska Kozioska, joined in 2001. That kind of tenure ensures incredibly deep institutional knowledge, especially of the Polish market and its unique, complex regulatory landscape.
So their market position is really clearly defined that. They are the specialists.
Exactly. Their market position is clearly solidified as the specialist for Polish SMEs. They differentiate themselves precisely with that deep institutional knowledge of Polish tax law. We're talking highly specific compliance stuff, JPK, ZUS, PIT, CIT.
JPK. What's that?
JPK is Poland's single control file. It requires businesses to submit highly granular, structured transaction data directly to the tax authorities, often almost in real time. It's not just filing. It's like a continuous, deep digital audit trail.
Okay, that sounds complex.
It demands specialized, constantly updated software and expertise, exactly like iFirma provides. This makes them really distinct from more generalized global platforms that might not have that same granular understanding of all the local nuances.
So their target customers aren't just any business anywhere. They're very specific types of Polish entities.
Precisely. Their targets are explicitly Polish sole proprietorships, the JDG's small limited liability companies, spółki z o.o., and online merchants, particularly those selling on big local platforms like Allegro. And this brings us to another key point. Their geographic focus. They are exclusively focused on the Polish domestic market. Period.
No international plans.
All their services, all their compliance features, platform integrations designed specifically for Poland. The company hasn't signaled any intentions, and the sources don't indicate any active plans, to expand their core accounting services internationally. They're clearly betting on deepening their penetration within Poland rather than looking abroad. It's a strategic choice in itself.
This deep dive into iFirma's sort of internal mechanics and focus is fascinating. But let's broaden the view a bit. They're obviously not operating in a vacuum, right? Especially given how dynamic Poland's fintech and business services sectors are. How does that wider environment shape their opportunities and, I guess, their challenges?
Yeah, what's fascinating here is just the sheer dynamism of the Polish fintech market. It's actually one of the largest and most robust in Central and Eastern Europe, CEE.
Really? Why is that?
Well, it's not just organic growth. Several key factors are driving it. First, really high internet penetration, around 84%. That provides a ready-made market for digital services.
Makes sense.
Second, Poland has this deep pool of skilled professionals, both in tech and finance. And third, the regulatory framework has actually become increasingly supportive of innovation, fostering a good environment for fintechs.
So lots of new companies popping up.
Dramatically, the number of fintech companies in Poland surged from about 167 in 2018 to nearly 300 by 2022. That's almost an 80% increase in just 4 years. Huge growth in digital payments, lending, and, of course, SaaS delivery, like iFirma's accounting solutions.
And this isn't just about fintech in isolation, is it? It seems connected to a broader trend in Poland's economy, moving up the value chain.
Absolutely. This fintech boom is definitely complemented by the strength of the broader Polish business services sector, the BSS. This sector is a huge contributor to Poland's GDP, estimated around 5.7%, and impressively, it boasts an export value over $42 billion. Now, what's strategically important for a company like iFirma is that the BSS itself is undergoing a big strategic shift. It's moving away from just being a low-cost outsourcing hub towards providing higher-value, knowledge-intensive services. Things like advanced data analytics, cybersecurity, sophisticated financial ops.
Right.
This macro trend naturally elevates the importance and demand for sophisticated, compliant digital accounting solutions, which is precisely where iFirma plays a crucial role for those small and medium businesses.
So it sounds like a big growing market with lots of tailwinds, but then there's this massive transformative regulatory change coming. You called it a tsunami earlier, that could just shake everything up. It creates huge opportunity, but also intense competition. Tell us about that.
Yeah, tsunami might not be hyperbole here. What's truly critical, and really a once-in-a-generation shift, is the sheer scale of these upcoming regulatory changes. It's both an unprecedented opportunity for some and, frankly, a crucible for intense competition. We're talking about a government-led, mandatory digitalization initiative. And this is, without a doubt, the single biggest growth catalyst for the entire Polish accounting software industry.
Okay, mandatory digitalization. What does that actually involve?
There are two key interlinked components driving this. First is the Krajowy System E-Factor, or KSEF. That's a national system for structured electronic invoicing that will become mandatory for all businesses.
All businesses. No more paper invoices.
Pretty much. It mandates that invoices must be issued and received through a central government platform, effectively ending paper invoicing for most B2B transactions.
Wow. And the second part?
The second, and perhaps even more impactful for iFirma's target market, those sole proprietors and small businesses, is the mandatory electronic KPR.
KPIR, that's the simplified tax book.
Exactly, the tax book of revenues and expenses. From January 1st, 2026, all taxpayers using the KPIR will be legally required to maintain these records electronically using certified software, and they have to submit them digitally to the tax authorities.
That is colossal for small businesses. I mean, many of them, as you said, might still be using paper ledgers or just basic spreadsheets. This doesn't just nudge them into the digital age. It practically shoves them, doesn't it?
It absolutely does. And this is precisely why it's such a transformative event. This mandate forces a very large chunk of the market, especially those small businesses, freelancers, sole proprietors using traditional, often paper-based methods, to actively seek out and adopt a compliant digital accounting solution.
So it creates customers overnight.
Exactly. This isn't just a tailwind for companies like iFirma. It's a fundamental market expansion event. It compels previously passive businesses to become active, paying customers. Imagine that small artisan or the local shop owner who's used a paper ledger for decades. Come 2026, they simply cannot operate that way anymore. They must go digital.
But this huge opportunity isn't just for iFirma, right? Which must mean a fierce battle for all these newly mobilized clients.
Precisely. That's the catch. This opportunity is not exclusive to iFirma, which is why it effectively creates what we're calling a jump ball scenario. Every single competitor in the market is going to be vying aggressively to capture this wave of newly mobilized clients.
So who wins?
The companies that succeed will be those with the most effective marketing, the most user-friendly transition paths, and the most competitive pricing. So while the opportunity to expand the total addressable market is immense, the execution risks and the competitive threat during this period are equally heightened.
Any signs of this battle heating up already?
Oh, yes. An analyst report from Millennium, for instance, specifically flags the very high marketing activity of the competition, including the main competitor, in fact, as a crucial variable in iFirma's ability to capitalize. This isn't a guaranteed win for iFirma, it's a battle for market share. And those who invest most aggressively now in capturing these new customers will reap the rewards down the line.
So how does Poland's consistently complex regulatory environment, things like the overarching Polish Accounting Act. How does that both protect and maybe subtly challenge IFirma in this incredibly dynamic situation?
Well, the Polish accounting landscape is governed by the Polish Accounting Act, which is actually undergoing significant reforms itself. It's aligning with broader EU directives like the Corporate Sustainability Reporting Directive, CSRD, PSD2 for payment services, GDPR for data protection.
Right, always changing.
Always changing. This regulatory framework is incredibly complex. It incorporates both national and EU-level rules with frequent updates. Now, what this inherent complexity does, ironically, is create a very high barrier to entry for new players, especially international ones.
So it protects the locals who know the system.
Exactly. It significantly benefits specialized local players like IFirma, who possess that deep institutional expertise needed to navigate these intricate and ever-changing requirements for their clients. It's like a natural government-imposed moat protecting incumbents who understand the local labyrinth.
Okay. And what about any recent changes? Anything that might simplify things or shift the landscape again, maybe regarding business size and accounting requirements?
Yes, actually, there have been very recent changes. Effective from January 2025, they've raised the revenue thresholds for businesses needing full accounting records and statutory audits.
So fewer businesses need the most complex accounting.
Potentially, yes. It might slightly shrink the pool of the absolute largest SMEs mandated to use the most complex forms of accounting, but it also simplifies the administrative burden on a great many smaller entities.
And how does that help IFirma?
Well, this simplification, paradoxically, could make those smaller entities even more inclined to adopt a streamlined, cost-effective digital solution like IFirma's platform, maybe over a more traditional and often more expensive accounting firm. It essentially frees up a segment of the market to choose simpler, more accessible digital tools, which is a subtle but definite tailwind for companies like IFirma.
This raises an important question then. With all these changes, the digital mandates, the shifting thresholds, how is the market for accounting solutions in Poland actually shaping up? It sounds like there are maybe two distinct types of providers emerging.
That's a good way to put it. The market does seem to be bifurcating, splitting into two main types of providers, each with a distinct value proposition.
Okay, what are they?
On one side, you have these hyper-localized Polish specialists, companies like IFirma itself, and another player we briefly mentioned, MK.PL. They fit squarely in this category. Their core value proposition, their competitive edge, is that deep, nuanced, constantly updated compliance with Polish-specific regulations. They live and breathe Polish tax law. They're the trusted guides through its complexity.
Okay, the local experts. And on the other side?
On the other side, you have the global SaaS giants. Think of names like Intuit with its QuickBooks platform and Xero.
The big international players.
Yeah, precisely. These are companies that offer incredibly feature-rich platforms, boast massive resources for R&D, and have globally recognized brands. And crucially, they are increasingly adding Polish localization features to expand their reach into this lucrative market.
So the battle is really in the middle ground where they meet.
That's exactly where the primary competitive battleground lies. The big question becomes, can IFirma enhance its technology and user experience enough to match the intuitive feel and feature breadth of these global platforms while still keeping its unique, deep Polish compliance edge?
And conversely.
And conversely, can those global platforms truly master the granular complexities of Polish compliance sufficiently to erode IFirma's core advantage? It's a real strategic tension. And actually, the acquisition of that local player, in fact, by the European software giant IFirma, that perfectly exemplifies this dynamic.
How so?
It shows a global player buying proven local expertise specifically to compete head-on with a company like IFirma. It really highlights just how serious the fight for market share in Poland has become.
Okay, let's unpack this competitive arena then, because IFirma is operating in a truly fiercely competitive market, especially with KSEF and KPR creating this jump ball situation. Who are the main players trying to grab market share, and what do they bring to the fight?
Yeah, the environment is definitely fierce. And it helps to categorize the rivals. The most direct, the most formidable competitor is unquestionably, in fact,
The one bought by IFirma.
that's the one. They're a Polish company, and they mirror IFirma's hybrid model connecting accountants with small businesses via a software platform. But the threat level just jumped exponentially in 2020 when they were acquired by IFirma. And IFirma is a colossal European software conglomerate.
So it's like bringing a very well-funded pan-European giant into what was basically a local scrap. That fundamentally changes the game for IFirma, surely.
It absolutely does. Visma's whole strategy involves acquiring successful local market leaders, like InFact, and then pumping them full of capital and tech resources to accelerate growth and dominate their markets.
So iFirma now has a direct competitor, similar model, local focus, but backed by essentially limitless cash from Visma.
Pretty much. And analyst reports explicitly identify the intense marketing activity from InFact as a primary risk to iFirma's growth prospects. Especially now, as millions of businesses are suddenly forced to go digital, they are outspending and outmarketing iFirma significantly. It's a major imbalance.
Ouch. What about other local players? Besides InFact, are there smaller, more niche competitors fighting for scraps?
Yeah, the market also includes other Polish-focused players like IFirma.pl, which we mentioned. They offer online accounting software specifically designed for Polish limited companies compliant with local rules. They're definitely a smaller, more niche player compared to iFirma or InFact.
Yeah.
Beyond that, the market's actually quite fragmented. Lots of traditional accounting firms slowly, maybe reluctantly, trying to go digital, plus smaller niche software providers. Everyone's vying for the same SME customer base. It's a crowded space, and the bigger players are clearly consolidating it.
And then looming over all this, you have the global behemoths, right? The SaaS giants like Intuit and Xero. How do they factor into this? Are they more of a long-term threat?
Long-term, yes. A significant strategic threat definitely comes from those global leaders. Intuit with QuickBooks, Xero. These companies command enormous R&D resources. They have globally recognized brands, sophisticated platforms, huge ecosystems.
Yeah.
Their main focus has historically been larger, more standardized Western markets, true. But they're increasingly offering localized solutions and tax compliance features for Poland. This strategic shift, even if it's gradual, could slowly but steadily erode iFirma's competitive standing over time, especially if their localization gets really good and they decide to throw serious marketing money at Poland. So what's truly critical here is understanding how iFirma has built its defenses, its moats, if you will, to protect itself from these formidable competitors, but also where are its key vulnerabilities, especially facing such aggressive rivals.
Okay, let's talk moats first. What are iFirma's key advantages?
The first, and arguably the most significant competitive advantage, is their regulatory and compliance expertise. They just possess this profound, long-standing expertise in Poland's uniquely complex, frequently changing tax and accounting rules.
Hard to replicate quickly.
Very hard. This builds an incredibly high level of trust with clients who, above all else, prioritize compliance and avoiding trouble with the, frankly, stringent tax authorities. It's their core competence. It's a key reason businesses choose them.
That makes perfect sense. In a country with laws like that, having a specialist who knows every detail is invaluable. What else protects them?
Second are the high switching costs. We keep coming back to this, but it's crucial, especially with their Biuro Rachunku, the accounting office service. It creates a powerful lock-in.
Right, not just data migration.
Exactly. It's severing that relationship with the dedicated human accountant who's deeply integrated into your financial operations, maybe holds power of attorney. It's disruptive, time-consuming, costly. It ensures exceptionally high customer retention once someone's onboarded. It's a real pain point that makes clients very hesitant to leave.
And building on that, their sheer time in the market, their familiarity, must count for something too.
Absolutely. Their brand recognition and tenure are undeniable advantages. Operating as ifirma.pl since 2001, they've built a long-standing, deeply trusted brand among Polish entrepreneurs. When a small business owner in Poland thinks online accounting, iFirma is likely a name that comes up.
Trust takes time.
Decades, yeah. That's not something a new entrant, even a well-funded one like Visma InFact, can easily replicate overnight. However, despite these strong moats, iFirma faces critical, immediate threats. The most pressing is their capital and marketing disadvantage.
The Visma factor again.
Exactly. The superior financial firepower of competitors, particularly Visma-backed InFact, is a huge concern. In this race to acquire customers during the mandatory KSEF cap year transition, this once-in-a-generation opportunity, the ability to just outspend on marketing, advertising, customer acquisition, it's a critical advantage that iFirma may simply lack.
Because of their conservative approach.
Because of their conservative capital allocation strategy, which we'll get into. This isn't just about brand awareness. It's about sheer reach during a crucial land grab moment.
So even with a great sticky product, If they can't shout as loud as the competitor, they might lose out on this massive wave of new customers. That sounds like a significant strategic vulnerability.
It is, precisely. And then there's the technological arms race. The software industry, as you know, innovates incredibly rapidly.
AI everywhere now.
Right. Global competitors like Intuit are investing heavily in advanced features. AI-powered bookkeeping they market as Intuit Assist. These innovations promise to make their platforms way more efficient, more appealing over the long run. They could potentially leapfrog iFirma's tech if iFirma doesn't keep pace with similar levels of R&D investment. It's not just about compliance anymore, it's also about cutting-edge user experience and automation.
Okay, so given these strengths and these pretty serious vulnerabilities, how is iFirma trying to differentiate itself? Are they leaning into their strengths or trying to play catch-up on the tech side?
Their differentiation strategy really hinges on their core identity, being the trusted specialist provider exclusively for Polish businesses. They are not trying to compete head-to-head with global platforms on sheer feature breadth or flashy AI everywhere.
So focus on the niche.
Exactly. Their focus is squarely on the depth of their local compliance expertise and the peace of mind offered by their unique hybrid service and software model. They're positioning themselves as the reliable, compliant partner for Polish entrepreneurs. That's an incredibly powerful message in a highly regulated environment where tax compliance is a constant source of anxiety for small businesses. They're selling assurance, not just software features.
Okay, assurance and expertise.
Yeah.
So what do the financials tell us? How is this strategy actually playing out in the numbers? Let's start with the top-line revenue growth.
Right, the numbers. Well, the company has shown a strong track record of consistent revenue growth over the past few years, which is definitely positive. In fiscal 2021, revenues were about PLN 33.5 million.
Yep.
That grew by a pretty robust 28.7% to PLN 43 million in 2022. Growth continued into 2023, hitting PLN 51.3 million. That was an increase of 19.1% year over year.
That sounds pretty impressive, solid double-digit growth. But looking at those percentages, 28.7 down to 19.1, I'm sensing a bit of a slowdown in the pace. Is that right?
You're perceptive, yes. While it's still impressive growth, preliminary results for 2024 show revenues reaching PLN 58.3 million. That represents a 13.7% increase compared to 2023.
Okay, still growing but slower.
Exactly. It clearly indicates a deceleration in their growth rate. So while they are still growing, still adding customers, the pace is definitely moderating, especially compared to that rapid acceleration they saw back in 2022. This really brings into question the sustainability of their historical growth rate without, perhaps, more aggressive investment, particularly as the market gets tougher. Now, if we connect this to the bigger picture, while revenue has certainly grown, the financial story gets much more nuanced when we dig into profitability and costs. The good news is iFirma has remained consistently profitable. They've translated that revenue growth into solid earnings. Operating profit grew from PLN 6.8 million in 2021 to PLN 9.6 million in 2024.
Okay.
Similarly, net profit increased from about PLN 5.3 million in 2021 to PLN 8.4 million in 2024.
So absolute profits are still going up, which is good. But you mentioned earlier that margins are under pressure. That sounds like a bit of a contradiction. Can you unpack that for us?
Yeah, it's not quite a contradiction, but it's a really crucial nuance that reveals the strategic tension they're facing. While absolute profits are up, a closer look at their margins reveals emerging pressure.
How so?
Well, for example, their gross profit ratio, which reflects the profitability of their core services after direct costs that declined from almost 39%, 38.76% in 2021, down to about 35.5%, 35.48% in 2024.
Okay, a noticeable drop.
And even more starkly, their EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, fell from a healthy 22.6% over that same period.
Right, so each zloty of revenue is becoming less profitable on a percentage basis.
That's exactly it. While they're growing, it's becoming less profitable growth at the margin level.
And what's causing that squeeze? Are their operating costs just rising faster than their revenues? Is it the accountants, the tech?
Precisely. A report covering the first half of 2024 noted that operating costs rose by a significant 29% year over year.
Wow, 29%.
Yeah, and this was primarily driven by higher employee expenses, particularly for those human accountants in the Biuro Rachunku segment, and also increased external IT service costs, likely related to maintaining and updating their platform. Now, that 29% cost increase significantly outpaced their 15% revenue growth for that same period.
Okay, that explains the margin pressure clearly.
Yeah, this trend points right to that classic strategic challenge. The company is facing a choice. Do they try to maintain historical margin levels, Or do they invest more aggressively to sustain growth in this increasingly competitive market? They're definitely feeling the squeeze.
And I saw something in the Q1 2025 results that might be related to this margin pressure.
Yeah.
Something about a sharp reduction in sales and marketing costs. That seems completely counterintuitive given the jump ball market opportunity we've been talking about.
Yes, that's an incredibly important counterpoint, and it raises a really critical strategic question. A Q1 2025 analyst report offered a bit of a surprise, yeah. It highlighted lower than expected sales and management costs. Specifically, there was a significant 47.1% year-over-year reduction in sales expenses.
Nearly halved. Why would they do that now?
Exactly. It immediately raises the question, is this a deliberate tactical cut in marketing spend to protect short-term profitability because operating costs are rising and revenue growth is slowing? Or is it a strategic decision to allocate capital elsewhere, maybe to R&D, though that wasn't specified?
If it's a cut to save money.
If it's a cut, it could be directly at the expense of long-term growth and market share capture, especially right now when investment in customer acquisition seems most needed because of KSEF and KPRR. It really just highlights the strategic tightrope iFirma's management is walking. It's a tough balancing act.
Okay, moving beyond the income statement and those crucial margin trends, iFirma's balance sheet tells a very different story, right?
Yeah.
One of exceptional financial health and prudence. Tell us about that side.
It truly does. The company operates with a pristine, virtually debt-free balance sheet. This has been a consistent feature for at least the last 5 years, probably longer. Practically none. This financial conservatism provides immense stability, resilience. It's definitely a core strength, especially in uncertain times. As of March 2025, they held about PLN 7.5 million in cash and short-term investments. And critically, their total short-term assets, around PLN 13.2 million, comfortably exceeded both their short-term liabilities, PLN 10.6 million, and their negligible long-term liabilities, just PLN 0.17 million.
So very liquid, very safe financially.
Very strong liquidity, virtually no financial risk from leverage.
But I've heard people say that being completely debt-free can sometimes be a double-edged sword, especially in a fast-growing sort of land grab market where your competitors are spending aggressively, maybe using debt. Does their prudence potentially come at a cost here?
That's a really perceptive point, and it's a core dilemma for iFirma, absolutely. While operating debt-free signifies prudence, low financial risk, great. But this debt-free status can also be viewed as overly conservative in the current market context.
How so?
It potentially leaves the company under-leveraged in what we've called this land grab market, where competitors, especially those backed by big entities like Visma, are using capital aggressively to acquire market share. It raises that uncomfortable question. Could iFirma be doing more to seize this KSEF opportunity if they were willing to take on some strategic debt? Or maybe just rethink their capital allocation priorities altogether?
Right, is that trade-off between absolute financial safety and maybe maximizing growth in this pivotal moment?
Exactly that trade-off.
And what about their cash flow? Are those profits actually turning into cash? Is it high-quality earnings?
Absolutely. iFirma is an exceptionally strong and consistent generator of operating cash flow. Their net operating cash flow figures were strong. PLN 7.4 million in 2022, PLN 8.1 million in 2023, PLN 7.8 million in 2024.
Pretty stable.
Very stable. And the close alignment of that operating cash flow with their net income demonstrates that the reported earnings are high quality. They're being effectively converted into cash. There are no red flags here related to working capital management or anything like that. Their cash generation is solid, predictable, robust, speaks volumes about the health of their underlying operations. So this raises an important question then. Who is actually steering this ship? And how are they deciding to use the company's financial resources? Especially given all these market dynamics, the strategic choices we've discussed, it really all comes down to capital allocation.
Right. And the management team is quite distinct, as we noted earlier. They're characterized by that exceptionally long tenure, deep Polish market experience. Wojciech Narciski, the president, founder, involved since 97. Agnieszka Kozłowska, the VP, there since 2001. That stability ensures consistent strategy, profound institutional knowledge.
Yeah.
Huge asset in navigating complex rules.
It is, but as we touched on, it also carries that potential risk of, well, strategic insularity. Consistency is often good, but in a rapidly changing, hyper-competitive market like Polish fintech, sometimes a fresh perspective or a more aggressive, less conventional approach might be needed.
What about the board overseeing them?
The supervisory board does bring strong external credentials, members from finance, investment, law backgrounds. Notably, the chairman, Dr. Mikasz Masowski, is also the vice president of the Polish Association of Individual Investors.
Ah, so likely shareholder-focused.
That suggests a board culture that's particularly mindful of individual shareholder interests, yes. Although it's worth noting, for investors really focused on governance transparency, some board members don't meet the strict formal independence criteria under Polish law. Not necessarily a red flag, but it's a factor a governance-focused investor might consider when looking at oversight, especially regarding big strategic shifts like capital allocation.
That's a good nuance. Okay, let's delve deeper into IFirma's really unique approach to sharing profits with investors. It's definitely not your typical dividend policy, is it?
No, it's anything but typical. IFirma has what they call a shareholder-friendly dividend policy, and it's quite distinctive even on a major European exchange like Warsaw. Since 2017, they have been the only company on the Warsaw Stock Exchange paying dividends quarterly.
Quarterly? Wow.
Yeah, they actually highlight this themselves in investor communications. It's a point of pride. These payments have been remarkably reliable. They've grown over time, offering an attractive yield cited between, say, 4.7% and 5.1%. So for income investors looking for consistent payouts, that's certainly appealing, especially when many growth companies retain all their earnings. But what's truly fascinating here is that while this dividend policy is attractive to income investors, it comes with a significant strategic cost, especially right now at this pivotal moment for the industry. The company's payout ratio is very, very high.
How high are we talking?
One analysis calculated it at an astonishing 85% of earnings and 70% of free cash flow.
Wow, 85% of earnings. That doesn't leave much left over for reinvestment back into the business, does it? Especially when you just described a market where competitors are spending like crazy to grab market share.
Precisely. It leaves a tiny portion of internally generated capital available for reinvestment. This policy creates a significant strategic constraint. We're at this critical juncture, right? Market fueled by mandatory digitalization, demanding aggressive investment in tech, marketing, customer acquisition, especially to fend off this main fact.
Right.
Yet, IFirma's dividend policy severely limits their organic ability to make those necessary investments without external funding. To fund growth initiatives, fight this market share battle, management would likely face a really difficult choice.
What's the choice?
Either cut the popular dividend, which would surely disappoint their core investor base, or take on debt, which, as we know, is something they have historically avoided completely. This makes their capital allocation policy a central risk factor, a key strategic question in the whole investment thesis.
And just to confirm, no debt and no share buybacks either. It's really all about that dividend.
That's correct. Zero debt on the balance sheet, reflecting that deep-seated financial conservatism. And no history of using share buybacks to return capital, unlike many other public companies. It's all about that consistent, high quarterly dividend, a very singular focus.
So how well does the company use the capital it does manage to retain, given it's such a small slice of their earnings? Are they exceptionally efficient with that little bit?
This is where it gets incredibly interesting, because despite that very high dividend payout, the capital that is retained within the business is utilized with exceptional efficiency.
Really? How efficient?
Their trailing 12-month return on investment, ROI, is an impressive 60.5%. The 5-year average is still remarkably high at nearly 51%.
Oh.
Similarly, their return on equity, ROE, very strong, forecasted at almost 58% for 2024. These are stellar numbers for capital efficiency.
So what does this all mean then? The irony here seems to be that these super high returns on the capital they do keep actually suggest that retaining more could be much more valuable for shareholders than paying it out. It's almost counterintuitive.
Exactly. It's a compelling irony. These exceptional returns on retained capital ironically strengthen the argument that the current dividend policy might actually be suboptimal for maximizing long-term shareholder value.
Because every zloty kept makes such a high return.
Exactly. Each Polish zloty retained generates a very high return. This strongly suggests that retaining more capital to fund these high-return growth projects, especially in critical areas like marketing and tech during this KSEF period, could be a more value-accretive strategy for shareholders over the long term, rather than just paying out most earnings as dividends.
It's that classic management dilemma, isn't it? Satisfy the income investors today or invest aggressively for potentially much larger capital gains tomorrow.
That's the heart of the dilemma for iFirma's management right now. So if we connect all this to the bigger picture, how is the market actually valuing iFirma? Does it reflect this balance of undeniable quality and these very real risks? It sounds like it's not a simple case of being obviously cheap or expensive.
Yeah, what are the valuation metrics telling us?
Well, let's look at some of them. Their price-to-earnings PE ratio is cited in a range roughly 17.5x to maybe 23x, depending on the analyst and the earnings forecast used. That generally places it a bit below the average of some larger Polish tech peers, like Brand24, but still above the broader Polish tech sector average.
Okay. What about price to sales?
The price-to-sales PS is around 3.1x. That's actually considerably higher than the peer average of 1.5x. It suggests the market is willing to pay a premium for each unit of iFirma's consistent, recurring revenue stream. They value that stability.
And the price to book ratio? You mentioned it was incredibly high, reflecting the asset-light model, right?
You're right to remember that. The price-to-book PB is exceptionally high, typically around 11.7x to 12.2x, miles above peer and sector averages. And yes, it's a direct reflection of that capital-light business model. They don't own factories or lots of physical stuff, combined with that very high return on equity we just talked about. Indicates efficient use of shareholder capital.
Got it. And EBITDA?
Enterprise value to EBITDA, which accounts for debt, though they have little based on 2024 forecasts, is around 18.6x. So when we benchmark iFirma against a curated list of its publicly traded Polish tech and software peers, the valuation looks reasonable, but not distinctly cheap.
It reflects that standoff you've written.
Exactly. The market seems to be giving it a premium for its fundamental quality, the debt-free balance sheet, consistent profitability, capital-light model, high ROE. They're paying for that quality and stability. But the PE ratio, while not excessive, isn't so low that it suggests the market is ignoring the significant risks we've discussed.
Right, seems to be pricing in the challenges.
It seems to be pricing in the intensifying competition from Vismainfact, the potential for continued margin compression as growth costs rise, and the strategic constraints from their rigid capital allocation policy. It's a real balancing act in the valuation.
Okay. And what about any growth-adjusted metrics, like the PEG ratio? Sometimes that can uncover a hidden bargain if growth is strong enough relative to the PE.
It can, but you need significant caution here. The PEG ratio for iFirma is cited as very low, around 0.39. Now, on the surface, that would suggest the stock is significantly undervalued relative to its growth rate. Looks like a bargain.
Yeah, usually anything under 1 is considered potentially cheap.
Right. But this metric should be approached with extreme caution for iFirma. Why? Because it relies heavily on historical growth rates.
Which are decelerating.
Exactly. Which, as we've noted, are decelerating. If future growth fails to match the high rates of the past, which is a real risk given the competition and margin pressure, then that low PEG ratio could be a very misleading indicator. It could be a value trap, not a hidden gem. It's entirely contingent on a reacceleration of growth, which is absolutely not guaranteed.
Okay, very important caveat there.
Yeah.
Let's unpack the flip side of the coin then, the risks. What could potentially derail iFirma's trajectory, even with its strong fundamentals and market position? For you, the listener, what are the key things to watch out for?
Right, the risks. The most significant one facing iFirma is undoubtedly competitive pressure. We've hammered this point, but it's crucial. The Polish online accounting market is increasingly attracting aggressive, well-capitalized competitors.
Primarily Vismainfact.
That acquisition created a direct rival, similar model, but now backed by massive financial and tech resources. This heightened competition could easily lead to pricing wars, significantly increased marketing costs for iFirma just to keep up, further margin compression, and ultimately an erosion of their market share if they can't respond effectively. This is the big one.
And linked to that, with the huge regulatory shift from KSEF and KPIR, there's also a big execution risk, isn't there? It's a massive opportunity, yes, but also a really complex challenge to manage successfully.
Absolutely. That brings us squarely to execution and market share risk. The government-mandated transition to electronic bookkeeping, KSEF KPR. It's, like we said, a monumental double-edged sword. Huge market opportunity, forces paper businesses digital, great. But iFirma's ability to actually capitalize on it is by no means guaranteed.
What could go wrong?
Failure to execute an effective, high-volume marketing and onboarding strategy during this critical period, well, that could result in significant market share gains going straight to more aggressive competitors, effectively turning a potential massive tailwind into a major strategic setback. It really is a race against the clock for them.
Okay. And what about the relentless pace of tech change in fintech? Can they keep up with the global giants and their huge R&D budgets? Is their tech going to look dated?
That's the technological obsolescence risk. Spot on. The software industry innovates incredibly rapidly, especially now with AI and automation advancements. Global competitors like Intuit are heavily investing in things like AI-powered bookkeeping, aiming to automate many manual tasks.
Making it easier, faster for the user.
Exactly. If IFirma fails to keep pace, doesn't integrate similar levels of efficiency and intelligence into its platform, its solution could start to be perceived as outdated or less efficient. That diminishes its competitive appeal over the long term. This isn't just about adding new features, it's about staying relevant in a rapidly evolving tech landscape.
And finally, pricing power. You talked about margin pressure. In such a competitive environment, can they even raise their prices enough to offset rising costs and maintain profitability? Or are they stuck?
That's a crucial point, pricing power constraints. In this increasingly competitive environment, their ability to implement significant price increases seems severely limited. That Millennium Analyst report specifically suggested future price hikes might only be slightly above inflation.
So no big price hikes to boost revenue or margins.
Doesn't look like it. They likely can't rely on price increases to drive significant revenue growth or easily offset those rising operational costs. An inability to raise prices effectively would cap revenue growth and make it very difficult to expand those already declining margins. It could squeeze profitability even further down the line. So this raises an important question. Beyond the direct business operations, what other financial or broader market factors, maybe less tied to day-to-day stuff, could impact an investment in IFirma?
Good question. What else is out there?
Well, first, we have to come back to the capital allocation strategy risk. We've discussed it a lot, but it's central. The company's rigid policy of paying out that very high percentage of earnings as dividends represents a core strategic risk.
Because it limits reinvestment.
Precisely. This policy severely constrains the capital available for crucial reinvestment in tech, in aggressive marketing campaigns, maybe even strategic acquisitions. It could starve the business of the very resources it needs to compete effectively right now at this pivotal moment, potentially leaving them vulnerable to rivals who are investing much more aggressively.
Okay, that's clear. What else? I think I saw some notes about their stocks trading volume. That can be a very real risk for investors, right? Especially bigger ones.
It absolutely can be. That's the stock liquidity risk. The company's shares exhibit very low trading liquidity on the Warsaw Stock Exchange. Daily volumes sometimes fall below 2,000 shares.
That's tiny.
It's very low. This poses a material challenge for larger institutional investors. Makes it difficult to build or exit a meaningful position without significantly impacting the stock price. It also tends to limit analyst coverage and broader market interest, which can keep the stock under the radar and potentially hinder its valuation, even if the underlying business performs well. It's a practical hurdle.
Makes sense. And finally, the broader economic picture in Poland itself. How sensitive is IFirma to shifts in its home market, given they're solely focused there?
Yeah, the macroeconomic sensitivity. IFirma's entire customer base is exclusively Polish SMEs and sole proprietors. So a significant downturn in the Polish economy, maybe a recession, maybe high inflation hitting small business solvency, maybe just reduced entrepreneurial activity that would inevitably hit this segment negatively.
Fewer customers going bust.
Exactly. It could lead to an increase in business failures among their clients, a reduction in their total addressable market, and shrinkage of their overall customer base. Their fortunes are directly tied to the health and dynamism of the Polish small business sector.
Okay, so synthesizing all of this incredibly detailed information, what are the ultimate questions anyone tracking companies like IFirma or maybe navigating similar market transformations should be asking themselves here? And maybe more importantly for the listener, what should you be watching for specifically in the next few years?
Right. Let's boil it down. To summarize, the primary drivers of IFirma's competitive advantage in Poland are clear, right? It's their deep, unparalleled regulatory expertise. It's the incredibly high switching costs from that Biuro Rachunkowe model. And it's their long-established, trusted brand. Those are their core defensible strengths.
But the sustainability of their growth is the major question mark, especially with revenue growth slowing down and these aggressive competitors breathing down their neck.
It absolutely is. While the mandatory digitalization via KSEF-KPIR is a powerful positive catalyst, it could reaccelerate growth by forcing new customers into the market. It's severely countered by that intensifying competition, especially Vismainfact. Sustaining double-digit growth going forward will require flawless execution, and crucially, a greater willingness from management to invest heavily, which really challenges their historical conservatism.
And that ties directly into the total addressable market, their potential market share ceiling. It's huge, yes, but they're not going to capture all of it, are they?
No way. Exactly. The total addressable market is millions of Polish SMEs and sole proprietors. The new rules make the entire non-digital market addressable practically overnight. Huge potential. However, iFirma's market share ceiling is definitely capped by this intense competition. They're unlikely to achieve a dominant monopolistic position.
So a significant player, but not the player.
Probably. They'll likely remain a significant but not overwhelming player, sharing the market with Vismainfact, other local specialists, and increasingly, those global SaaS platforms. Their ultimate success will be defined by their ability to defend and grow within their core niche, those clients who prioritize localized, service-oriented compliance above all else.
Which brings us right back, inevitably, to capital allocation. How effectively has management used capital historically, and what are their future capital needs in this new, much more aggressive environment?
Historically, management has been extremely prudent. Strong bias towards consistent shareholder returns via dividends. The debt-free balance sheet, the high ROIC figures show that retained capital is used very efficiently. However, as we stressed, that high dividend payout may be suboptimal for the current strategic context.
And future needs are?
Future capital needs are significant. To compete effectively against Visma, to capture a meaningful share of this KSEF transition, iFirma needs to substantially increase investment in marketing and sales, to acquire new customers, in technology, to enhance their platform's user experience and keep pace with competitors' innovations in AI and automation. The current capital allocation policy just does not appear sufficient to meet these future needs organically. That poses a real strategic dilemma.
So the key risks we discussed are all intricately tied together then?
Precisely. The three most critical risks, I'd say, are 1, the competitive threat, particularly Vismainfact; 2, the capital allocation constraint, where the high dividend prevents necessary investment; and 3, the execution risk, where they fail to effectively navigate KSEF-KPIR and miss this huge growth opportunity due to insufficient investment or flawed strategy.
And finally, that valuation question. How does the current price stack up against its intrinsic value? Is it a good buy now, or is it maybe priced for perfection or even overvalued given these risks?
Yeah, the valuation reflects a market that's acutely aware of both the strengths and the weaknesses. It's not a clear-cut case of over or undervaluation. The market assigns that premium for iFirma's high-quality fundamentals, profitability, ROE, debt-free status. But it also appears to discount for the significant competitive and strategic risks we've detailed.
So an investor's view depends on?
An investor's assessment of intrinsic value will depend heavily on their view of management's ability or willingness to resolve that fundamental tension. The tension between its conservative capital allocation policy and the aggressive investment required by the current market dynamics. It really is a valuation tightrope they're walking.
Okay. And looking ahead, what about potential catalysts? Things that could drive the stock significantly up or down in the next few years. What specific signals should listeners be watching for?
Good question. For potential outperformance, look for tangible evidence of successful customer acquisition from KSEF-KPIR. A reacceleration in revenue growth would be key.
A change in strategy.
Maybe. A strategic shift in capital allocation, like, say, a temporary dividend cut specifically to fund a major marketing push, or a significant tech upgrade that would signal a proactive focus on long-term value creation over short-term payouts. Also, any stabilization or even better expansion of operating margins would be positive. It would indicate competitive pressures are manageable, not leading to a race to the bottom. Conversely, potential catalysts for underperformance. Watch for public announcements or analyst reports detailing significant market share gains by competitors like Infact, showing iFirma is losing ground.
More bad numbers.
Continued deceleration of revenue growth, persistent compression of margins, those would signal a loss of competitive advantage. And perhaps most critically, an inflexible adherence to that high dividend payout policy, even in the face of clear, urgent investment needs, that would signal strategic inertia, which could be very damaging in this rapidly evolving market.
So as we wrap up this really comprehensive deep dive, what are the key takeaways for anyone tracking companies like iFirma, or maybe just navigating similar market transformations, where you have this mix of strong fundamentals but also intense competitive pressure and these tough strategic dilemmas?
Yeah, this deep dive into iFirma really underscores a fundamental question for any investor, I think. In a market undergoing forced government-mandated digital transformation, where do you ultimately find long-term value? Is it in a company's demonstrated financial prudence and steadfast loyalty to shareholders through consistent dividends?
Or
Or is it in its willingness to aggressively invest and adapt, even if that means some short-term pain, maybe a temporary deviation from historical norms like cutting that dividend?
it's a fascinating question.
It is. Consider how different companies might navigate such a pivotal jump ball moment. Which path do you think will ultimately create more enduring value and competitive advantage in the long run? Especially for companies operating in a hyper-competitive, fast-changing industry like fintech, it's something to really mull over.